there, this is James, and you're watching Tixee Live. And a very good morning to all of you, and all of you a very happy Tuesday. In today's program, I want to have a quick chat about certain rumors going around, which is clearly underlining how the tech industry is beginning to really struggle. Plus, some latest data out of the UK and the fact that the market is still in a pretty bullish mood. But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, according to the New York Journal, okay, the cull of these big tech companies is continuing, because according to the New York Times, according to the New York Times, they have said that Amazon is expected to lay off 10,000 employees. And this could happen as soon as this week. And don't forget, we've already seen mass layoffs from some of the other really big tech companies. Twitter, for example, once Musk took over, they fired 50% of their workforce, fired a total number of 3,700 employees. Meta, Facebook, they follow suit. They also fired, but they fired a bigger number, 11,000 employees. And that was last week. So obviously, Amazon is rumored to be the next one. And like I said, we spoke about this before. A couple of months ago, these big firms, including Alphabet, announced they were going to do freeze hiring. But now, obviously, it's getting to the point that they're obviously having to trim their workforce quite dramatically. I mean, the tech sector is really struggling at the moment because obviously, clearly, there's signs of a slowing economy, rising interest rates, which are all, very high interest rates, which is obviously putting the strain on them as well. Hello there. Hello there to you too, Tony. I hope you're well, my friend. Good to see you. Hello there. That's my line. So obviously raising interest rates is not happening, and very stubborn inflation is also hurting them. Like I say, I know we had a cooler inflation number last week, but it's still 7.7 year on year, and 6.3 is still extremely high. Now, if these layoffs do indeed happen by Amazon, they mainly are going to impact, apparently, Amazon's Alexa business and obviously the retail human resources divisions. And you can see a reason why, for example, the Alexa group, okay, is going to be favored. If this cull does happen, it is favored to be the sector which is going to be hit by the most, because Alexa group, which produces, like I say, the Echo hardware, is losing around that $5 billion a year currently at the moment, which is not good at all at the moment. Like I say, they've had a pretty tough year. All tech companies have had very tough years so far. Facebook in particular are struggling. Even Alphabet disappointed in the most recent earnings Apple did. All showing very disappointing earnings. And like I say, Amazon's share value is actually down by 40% year to date at the moment. Yes. Well, unemployment is still low, actually. But yeah, hello there. I will talk to you. I'll talk about that. That's one of my other bits and pieces I'm going to bring up in a minute. Some other data which has come out from the UK. So yeah, I was going to get to that. So don't worry, that's for part 2. Don't worry. But hey, good to see you. But still, sorry, we're all now into UK is pretty much in a recession. Pretty much in a recession. But we'll talk about that in a little while. But good question. Good to see you. So like I say, Amazon is down. And if you look at the most valuable companies in the S&P 500, which includes Apple, Microsoft, Alphabet, Amazon, and now obviously Berkshire Hathaway, like I said yesterday, these are all very large tech companies, which the problem that they're going through, the reason why it's hitting them now with the labor force is because during the COVID lockdowns, they received so much money because people were stuck at home. Obviously, Amazon, buying stuff on Amazon, online all day, that sort of stuff. They hired so many people to handle the demand, that now, because they're changing their habits and people are not locked down anymore, they're changing to, traditional ways of shopping, and they're changing their buying habits in particular. It's, they grew too quickly. They've had several years of low interest rates and boom, boom, boom. So now they're getting to the point now that they expanded too quickly, hired too many people, and the demand is just not there. So I think this is a sign to come for quite a few other companies. Definitely likely to see. What do I think will happen to Apple and Google? That's a really good question, Tony. A really good question. Look, Apple today, Tim Cook today, he did announce that Apple will continue to hire for certain positions. They did say they were going to start hiring for certain positions, but not massively, not as big as they used to be. And like I say, this is the issue. Google has already said they're doing an employment freeze, so they're freezing the amount of people they're employing now. But whether or not they will do a cull, which follows suits, time will tell. Like I say, Amazon at the moment is just an article in the New York Times, so it's yet to see it happen. But I think the chances are, bear in mind they closed a number of stores as well, Amazon, a few months back. I think it's true. I really do. So I think Google will stop hiring. Apple may stop hiring. I think we might see some Google, because Google, like I said, they have about 135,000. They hire about 20,000 people a year. That's obviously going to stop or slow down now. Whether they do a bit of a cull as well, only time will tell. But I think all the tech companies are struggling. I mean, Apple is disappointed. Don't forget their iPhone 14, their flagship iPhone 14. The demand has not taken off. They've cut on production, reduced production by 3 million units. So it's just simply not selling as much or as well as they had hoped. Anyway, still selling because Apple, and people still love Apple. They still go and buy Apple, but it's not selling as much. So, like I said, I think in general these big tech companies are really showing this strength, and this highlights how I feel many job cuts have been recently by many big players. You're absolutely right, Wall. They are. I mean, this is the signs of the times. Signs of the times that I have no doubt that we're on the brink of falling into recession. And if these big companies are struggling, okay, then you've got the trickle down effect to all the other smaller businesses, obviously, who they do business with them for other certain things. So it's a slowdown in all of it. But it's a very good point. Yeah, like I say, and I think there's more to come. I think Apple, but definitely Google, we might see something similar in the future. Definitely. Anyway, moving on to that question, which is part two, which I said I'll get to, which is this question. UK unemployment record wages rise, but unemployment is still high. That's a good question, but it's not. Let's talk about it. It's a good question, but let's go through it together. Because yes, UK labor market is beginning to slow down, but it's still very stable. And I'll tell you the reason for that. Claimant count, which is the number of people signing on for unemployment benefit for the first time, came in at 3.3 thousand. Not that scary, only 3,300 people signed on for unemployment benefit. Still not good, but not scary. And in fact, the previous figure, they revised it down to 3,900. The original figure they had at 25,000 plus. So again, it's not great, but it's not awful. So it's showing that the UK labour market is still pretty stable. And here's the thing. Unemployment's 3.6, 3.5 previously. That's still low. That's not that high. It's still pretty low. And there is a big reason for this. And there's another reason for this as well. Average earnings came in better at 5.7 versus 5.6. It's average earnings not including bonuses, by the way. So no problem at all. Don't worry, that's what I'm here for. It's okay. It's not. Look, any question, anything, any input is always great. But anyway, no, that's great. Don't worry. Thank you for the question anyway. But there is a reason why you can look at this as reasonably stable, okay? And there is a reason. 8 for 1, okay, unemployment's 3.6. Average earnings is gone up, so that's better for inflation or the cost of living. It's not great, but it's better for cost of living. Our claimant count is on the rise, but again, it's not skyrocketing up. Yes, it's going to rise more, Okay, these are signs that though it's stable, the UK labour market is beginning to crack, and we will see more cracks because, like I say, the UK is on the brink of recession. But the other reason why this number is not, looks better than it is, it's not because of the unemployment is high or is rising. It is rising a bit, but the reason is we have so many job vacancies in the UK. There is so many job vacancies still in the UK because they're having trouble. They're struggling to fill these positions, which is a false number. There's about 1.2 million vacancies in the UK at the moment, around that sort of figure, according to recent data. But they can't fill it, and the reason for that is ever since COVID, people have changed the way they do, where they work. There are so many more people now who can't work because they're long-term sick. And that's why that number, like I say, it's on the move up. It's a bit misleading, but clearly because the labour market can't fill the positions. And this is also the reason why average earnings is going up. Because for the positions are obviously having to pay slightly more to attract the people. So that's it. So like I say, not shocking, not brilliant, but not bad. But there's cracks beginning to show that the UK is a matter of time before they will get into recession, and that number will start to rise. Next up for the UK, though, of course, we have UK CPI, which is due tomorrow at 7 a.m. 7 a.m. UTC. Expectation is to come in at 10.6. Previous reading was 10.1. Now, don't forget the Bank of England had said they expected it to be about 11% by November, or by October, in fact. So though we're getting close, 10.6 is the expectation. And the other big thing coming up, and this is happening on Thursday for the UK, is Jeremy Hunt, the Chancellor of the Exchequer, will present his fiscal statement on Thursday. His new sort of like mini budget. He will present it to Parliament. And clearly in this statement, he needs to plug a hole of 50 billion. So we're expecting tax increases, not tax cuts. He's not doing a trust. He's not doing that. No. Tax increases and cuts in public spending to fill this void. So we're going to have a look at it and see how the market reacts to this and see how it takes to it. Good job. Thank you, Moses. Thank you. Any comment about Euro's recent strength against the dollar, James? Yes, I've got loads of comments about that. But what I'll do that in a minute when we talk and look at the market. But yes, I have lots of comments about the euro and about the dollar, because obviously, as we're seeing at the moment, the dollar is slightly weak. But yes, I will talk about that in a minute. Really good question. Hopefully the mini budget isn't going to be appalling like the previous. No, this is going to be quite, I think we already know what it's going to be. We already expect tax increases and cuts in public spending. It's going to be almost polar opposite to the one we had in September. But it'd be interesting to see how the market is handling it. I think we pretty much expect to see what it is. Anyway, before I move on to another story and indeed start talking about the euro and the other currency pairs and the strength against the dollar, there's something else I just want to quickly share with you. I'm a big fan of the Elliott wave theory as well, by the way.
Let's go.
Very big fan.
I traded the DAX in the morning, showed some really good signs of volatility as well.
Anyway,
join James and Stephanos every Wednesday at 1800 UTC for another lesson at Tixee Trading School, your key to a better understanding of the financial markets.
There we go. Yes, that's indeed. We had the next episode of Tixee Live Presents the Trading School, which of course is tomorrow at 6 p.m. UTC. Myself and my colleague will be discussing the topic. The topic tomorrow is going to be understanding chart patterns. So please come along for that. Don't forget, like I said, these are live broadcasts, but they're not broadcasted live on YouTube. They come on YouTube a couple of weeks later. If you want to come and attend it live, there's a little link in the description below this little video. Click on it. And then register, and I hope to see you tomorrow. Anyway, leading on to obviously this brilliant question about the euro and obviously where it is at the moment. And the reason being, of course, at the moment, we are seeing a bit of risk on appetite, and there's several reasons for that, especially like with the euro. We are seeing a bit of that, and we basically there's anticipation. It's again, like I said yesterday, maybe we're getting a teeny weeny bit ahead of ourselves because of the CPI, but there is really building up anticipation of obviously only a 50 basic point rate hike by the Fed in December, followed by a smaller one in January. And the market's sort of getting itself convinced that by the quarter of 23, the Fed will start reducing interest rates. I think that's a bit premature. But anyway, they are boosted up by the 50 basic point rate hike on its way. In fact, Fed Chair or Vice Chair Brainard, he said yesterday, I think it will probably be appropriate soon to move to a slower pace of increases. But I think what's really important to emphasize, real important to underline, that's basically what he's saying, is we have additional work to do. Now, here's the thing with these comments, okay, how the market, okay, the market's looking at the 50, but they're forgetting other things they're saying. He's saying that they're not going to stop. They're not still got work to do. They've still got work to do, because that's what he says. He still has work to do. You know, it's not over yet. Just because they can start slowing down the size of the hikes doesn't mean they're going to stop doing it. So this is, again, what the market's getting itself a little ahead of itself about. And obviously there's huge expectation of 50 basis point rate hike. But that is why we're seeing a lot of strength in the euro and the sterling and the yen currently against the dollar. This is why we're seeing this. It's because obviously we have a risk on appetite, fueled obviously by that cooler CPI number, which we got last week. But like I say, there's still a lot more to come. Let's have a quick look at the markets now as it stands. It starts off with the euro. As we can see, again, we are way above parity once again, which is nice for the euro. Currently trading at 1039.58. Realistically, for me, I see the next real key to, psychological to break to stay above the 1.04 level first. Potential area of interest, potential support, potential buying around the 1.02710. So I'm keeping a close eye on that for a potential support. Sterling, again, sterling's benefiting as well. Like I say, we have a weak dollar purely because of that. This is why he likes the euro, and the sterling and other currency pairs are benefiting. We are trading now above that 100-day moving average. Okay, currently trading at 118 again, which is really good. I mean, if you think about it, since the lows of September, the sterling has bounced back for 15% since hitting the lows in September. So it is coming back. Currently trading at 118.226. I think realistically, potential support area of interest is the 100-day moving average at 1.1683. So it is coming back. Overall, though, don't forget this year, the sterling is actually down 14% against the US dollar year on year. So not great. Dollar yen. Dollar yen, again, like I say, we talked about this yesterday. We are still seeing the yen strength, still trading just below the 140 level now. Key area for me, that 100-day moving average, which tried to challenge yesterday but couldn't, 140.86. Gold is pretty much the similar, again, favoring pretty well. We've had now, 4 days of gains for the yellow metal, my beloved yellow metal. Currently trading at $1,776. Key area for me next, I'm keeping an eye on key area of interest, $1,803 an ounce. So that's where we stand at the market currently at the moment. Other things to come. Obviously, already mentioned the EU GDP, which is out just a minute. It's actually come out a few minutes ago. German zoo survey, UK CPI tomorrow, UK PPI, US retail sales, Canadian CPI, Landguard to speak, Australian unemployment rate, US building permits, US initial claims, and UK retail sales. So still plenty to keep an eye out and look out for. Yeah, well, I used to be a gold trader years ago, so that's always been my first love in trading is gold. That's how I always started it. That's what I started out with. And I remember when I started, gold was trading at $636 an ounce. It goes to show how old I am. So plenty to come for the market this week. The European equities, as they currently trade, FTSE currently in the green, 0.11%. DAX currently trading slightly in the red, 0.14%. And Eurostock 50 currently trading in the green slightly, 0.15%. Don't forget, you can ask me questions anytime, like all these good people have been today, which is fantastic. You know, it's always nice. So a big shout out to everybody who said hello and asked questions. Don't forget, as I always say, if you think of a question later, you can put it in the comment section, either in YouTube or Facebook. I will see them and I will reply to them next time I go live on air, which of course would be later today at 3 p.m. UTC to cover the US session. Okay, if there is no questions, no problem. Shout out as always to SNF 790, Raul R, Moses, and Tony for the questions and for the interaction. Really, really, really do appreciate it. I really do. Anywho, until next time, like I always say, if you're watching me on Facebook and you like this little video, by all means, give us a follow. If you're watching this on YouTube, like this little video, subscribe if you like. Hit the notification button so you know next time when we're going live. If you enjoyed this video and found it interesting and useful, and you put up with me, my over-the-top enthusiasm for the markets, I just can't simply help, then give me one of these. It's nice to know that you like what I do. Anyway, one more question. There is a question. No, I'm not doing a watch along this week. Instead, I'm going to be doing a hashtag Ask James episode on Friday instead. So subject is currency correlations sent in by Arthur57. But I'll talk a little bit more about that, closer to Friday. But no, not this week. Anywho, as I always say, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.